Thank you, Brett. I'm not walking into Brett's hairdresser. That's because I'm a stockbroker, so I'm cheap, so I do it myself. Thanks to Brett for inviting me here today. I'm just quite happy to get the invite. Always happy to come to Galway when Todd Carney's in France. Yeah. But I thought that I'd come along here today and give you a bit of a report. We had a recent report from our head of research, Tanya. That didn't work very well, did it? Tanya Brownway. Tanya got picked up by the Future Fund. Tanya got picked up by the Future Fund just recently anyway to pretty much take over a lot of their strategy, which was what she was in charge of with us at Macquarie. And the last piece that she had was very insightful, and I was just thought I'd go through that in a little bit more detail for you. So first of all, our disclaimer. So as you can see, not really. This is all general, and so it's things that we have to give you at the start of any presentation anyway. Current market conditions at the moment, as you all would have seen, or would have noticed from the RBA rate cut, current market conditions are currently a little poorer than they have been previously. The main thing we can look at here is the big cut in the average GDP growth from 93 to 2008 down to 2008 after the GFC. Hasn't really come back that strongly. There was an initial boost back, and then it's come along at a lower rate. With unemployment rates there, starting to see pick up in the Australian unemployment, which is now going to be moving underneath the above the US rate of unemployment, first time since the late 90s. As the mining boom and comes off, more jobs are coming back into other areas.
Do you think it's a mining boom or just cyclical with the mining industry?
There's cyclical in the mining industry in relation to, there was a huge ramp up over expansion from China because of the Olympics as well. So you had the 2008, everything had to be done, everything had to be put in place there. So there was, at any price, they would buy everything, and so then you had a huge ramp up in the majority of mines in relation to how much they were shipping out. Rio Tinto, BHP, Fortescue have all shown that they have increased their volume enormously over this period of time. So the smaller ones are a little bit, finding it a little bit harder anyway at their prices, because the previous prices are no longer there. Whether that picks up remains to be seen. But what we go into here, and the main thing of what was discussed is this a standard cyclical movement, or is it a structural change in relation to the ageing population? It's not just Australia that is faced with ageing population, it's just pretty much the Western world that is faced with an ageing population. This brings into account a lot of changes in relation to purchasing, all their kind of habits and different things as people move into retirement and what their lifestyle habits become from then on. So what we've seen at the moment is the wage growth drop from where it was before. That's once again jobs being lost in the higher paying sectors and coming back and having to be picked up in other areas. So what that has done is what you normally do in this situation, so I should pass these out. What we've got here, this is the old index chart, which comes out every year. And Brett, my good-looking assistant, just at the top there, mate. So what we would do normally is that we would go through what's happened with the market and what's happened here and there, and you give people a story about what's going on, saying, okay, what we've had now is the Reserve Bank rate cut, and where to from here? And you'd say, take a look at this, year after year, from 1950, even with all the different things that have come into play, all the recessions, all the OPEC oil issues, embargoes, and 1987 crashes, and all these kind of things, the market continues to move up. Businesses continue to expand. Cyclical changes happen, and they come back, and we move from bottom right to top, from bottom right to top left of screen. And the question really is then, is it the same again? Do we pick up from here? And it's quite difficult because of the fact that since 2007, we expected to see a big pullback after it was sold down so heavily. We knew that there'd be a big uptick in borrowing and so forth once the banks came back online. But after that, that hasn't continued on. The growth that we've seen has kind of remained weak. And what we are looking at is the structural change of an older generation moving into retirement. You've got the people that were in retirement hit by the GFC. They've really then moved to shore up their retirement savings, moved very much out of any kind of extra risk that they may wish to take on board. You've got other people that are moving into retirement who are then moving away from any expansive debt that they may have had. Anyway, the consumption patterns, the deleveraging that we're seeing is we expect to continue. So there's a number of different areas that we can show this consistent trends over time in reduction in Australia's per capita consumption spending and their housing credit growth. This is the per capita consumer spending that we've seen over a number of years. And as you can see, from 98, it's been coming down from actually that's the last one there. So probably the mid-90s has been trending lower per capita consumer spending. And we're also seeing retail sales and housing credit growth peaking in 2004 and then coming back since that. I mean, you could say that there was a big pickup in housing prices from 1990 to 2004. There's been a lot of equity and not so much credit being needed. But you could also then say, you ask any non-baby boomer how big's their mortgage at the moment, and they would suggest it's pretty high. So the requirement for quite a big amount of debt still remains on people who are entering the market and who are starting out, as opposed to the people that were in the market and who are approaching the retirement age have got a great deal of equity in there, who are not getting the extra debt, who are not doing that, who are not adding to the credit growth. So the question there is this a structural change? This is a big part of this, and we accept that the move of the baby boomers into their retirement status is a structural change. Then the big question is, what should we be ready for? How do we profit from the fact that we look around and say, okay, we've got an ageing population. This is going to change how people spend. This is going to change how people holiday and what they plan to do. So what can we do from what we expect to happen? Inflation should remain lower for longer. Baby boomers are going to partake in dis-saving, deconsumption, wealth dissipation as they spread their money out today, so they have their holidays. But by and large, they're not spending up big. They're not undertaking large expansion there at all in regards to debt. Interest rates from that should remain lower for a far longer period, with inflation expected to stay lower. Commodity markets, consumer goods markets, face prospects of excess, hence lower prices. We've seen that commodity markets and so forth, not so much due to the ageing population, but just mainly due to excess supply that has been coming on. But we expect quite a deal of that to continue. And then from that, asset prices are going to have to adjust. Basically, with low interest rates, lower levels of sales growth, there's going to be a bit of lower profit growth. So, normal returns for all assets on average will be lower. What this will lead to, that we should see, is that companies that do well are going to have access to lower interest rates. They're going to be looking at picking up other companies that they can take on either mergers and acquisitions. So we're expecting quite a deal of M&A going on in the next few years. And there's a lot of areas for investment that you can look at, and the main one that we've seen in the last few weeks is when the Reserve Bank dropped their rates, and that was actually a couple of weeks before that, there was the rumours that they were going to, and all the banks and Telstra and so forth shot up. And that's basically the risk appetite, investment preferences for the baby boomers and so forth are for yield and for ability to strong cash flow. So those areas are going to be the ones that are still very heavily wanted. So from this, I mean, this goes through what we should look at if we agree with the statements above. The profit growth and earnings per share for equities could be lower. Now, what's happened in the last year and a half is that companies aren't getting any boost from a higher PE. So the higher PE is an expectation that earnings are going to grow, and this company is in a good area, so it should get better. They're basically getting priced on what their earnings per share is, what they're reporting on the growth, and also what their dividend yield is. And so there's still a number of good companies out there that will get rewarded by consumers and by investors who are able to show good cash flow, who are able to pay a dividend yield which is supported. And what we're seeing at the moment as well is that there's quite a big gap between what you call the risk-free rate, or the bond rate, and what the dividend yield of the senior companies is. And we expect that yield to be compressed, which means that the price for these shares will continue to go up until that yield for these stronger companies that display strong cash flow, strong ability to continue to give a decent return to their investors, comes back closer to the risk-free rate of bonds. At the moment, it's very high. Areas that we expect to do well, companies that are still going to have high degrees of demand: healthcare, consumer services, IT services, people like Brett looking after older generation who are wanting to keep up to date with Facebook and the rest, and all their new technology requirements. Services is a hard thing to oversupply, so we expect that to continue to remain strong. Other areas, I mean, companies that are good companies will continue to be good companies, and that's run on the back of strong management. I'm a big believer in it doesn't matter how big company is. It all started basically at a level like this, and then grew from there with strong management, ability to look after your bottom line, and grow internally before they looked at taking on other areas and growing into the big publicly listed companies that we see today. So strong management, I think, makes up a huge part of a good company. Keeping the cash flow in check helps to be able to continue that dividend payment, which is going to get support from investors for a fair few years to come. And then also companies with an international focus. We believe the Australian dollar's still got some room to go further from here. There's a big expectation that there's going to be another rate cut. There was Reserve Bank came out yesterday and said that they weren't quite sure whether or not they should have cut in February or in March, but then some of the other details in relation to unemployment numbers and jobs growth number, pointing towards a further rate cut. I know we've been expecting that for, we were saying 2 rate cuts last year. Westpac was saying the same thing. There was ANZ was saying the same thing as well. So we're expecting another rate cut this year as well, which we would expect to actually continue to push down the Australian dollar for the next, for the next while.